Anup Maheshwari, EVP and Head Equities at DSP BlackRock Investment Managers, believes that the downside in the rupee is not over yet and the sharp depreciation will add to the macro woes for India. In an exclusive chat with us, he also spelled out his investment preferences for the year ahead.
Well, we're not entirely surprised with the trend. I think that was something that was anticipated, the fact that the rupee would depreciate. And in a sense, the rupee has become the pressure valve for the economy in a way. But I think the pace at which it's happened has obviously caught everyone a little off guard. And it seems to be fairly synchronized with what's happening in the ASEAN region generally. So I think a combination of the fact that we've seen some fairly significant debt outflows in the past 2 weeks, and that's been a phenomenon across the region, and that's another reason why currencies have weakened quite significantly. So the weakening itself is not surprising, but it's happened a lot faster than one would have liked.
Large part of the re-rating of in Indian markets in April was a process of drop in crude and a crack in gold, and there was this basic assumption that macro for Indian economy going forward will improve. Do you think that big picture is now getting challenged?
Well, we still hold that picture in the sense that it does look like oil generally will remain on the weaker side and therefore will at least not tremendously add to the deficit. Similarly, gold, I think the government's done a lot on the policy front to try and curb it. So clearly the currency does complicate the situation and makes it a little more expensive. But I think as a trend, we still believe that the macro picture is getting better, not worse, so at least stabilized, unlike it worsening to a point where we really didn't know where it was going 6 months to a year ago. So I don't think the macro is as much of an issue. It's just that again it just sort of slows down the pace. So for instance, if interest rates were heading lower with such currency volatility, we have to see what the effect on inflation will be and whether interest rates can continue to move down the way we would have liked them to have moved down. So I think what it does is it just sort of extends the period of the economic recovery a little further out and makes it a slightly slower process than we would have liked. But I think as a process, that improvement is gradually beginning to occur.
So you're making a case that things are not that bad. In fact, one should really have this glass half full approach. Why are you painting a constructive picture?
Well, for a couple of reasons. I think for us, one of the biggest important triggers for looking back at equities as an asset class and sort of talking to people about it is the fact that interest rates are heading lower. I mean, they have come off quite considerably. Now, interest rates coming down over a period of time will help because it clearly finally seeps itself into balance sheets. And you do have a situation where if assuming capital is available, and it will be at some stage, the whole investment cycle also has the potential of coming back. So typically we've seen these sort of economic phases in the past. So the late 90s was not very different. And then, we had a very good period after that. So you have these sort of boom and bust cycles through economic phases. But the important thing is, how do all the macro variables readjust? So now the fact that interest rates have started coming off, the fact that the rupee is already depreciated, these are all parts of the repair of the balance sheet process that are underway. So all of that will result eventually into some basic improvement, and somewhere down the road corporate confidence will come back as well. So for us, the biggest catalyst for being a little more optimistic longer term is the fact that interest rates are lower. The fact that we've now seen a situation where balance sheets, slowly the deleveraging cycle has begun to occur. You're seeing corporate profitability, which has been very modest for the last 4-5 years, again now stabilizing, and maybe there's some potential for a pickup with a lag. And all of that, when you put it together, eventually you want to be a little more optimistic. Now, if markets correct in the meantime and offer us a good valuation as well, I think that is the ideal combination for a medium-term investor in terms of all the variables gradually falling in place and the valuations also being reasonable.
But are valuations reasonable because what is growing is expensive, what is attractive is not growing?
Sure. So I think you're quite right. There has been a big divergence in valuations amongst stocks. So I think the good thing about that is there's always investment opportunity, because there is something that is very cheap in the market in some ways. At the same time, we've seen expensive stocks do also tend to stay expensive if they're good businesses that are continuing to grow. So I think there will be opportunities on both sides for any investor over a period of time. But overall, if we just had to, for the sake of convenience, put it all together into an index valuation, ideally we'd clearly like to see some degree of correction to have higher margin of safety. So the market multiple is not very far from its long-term average. Ideally, if it was a little lower, it just gives investors that additional margin of safety. And generally, for anybody involved in equity markets or looking at investing in the asset over a period of time with money to be put into the market, you should be actually happy if there's a correction, because effectively you're buying a lot of these companies cheaper, which will enhance your returns in the future. So I think a correction is good if it were to occur. It will allow valuations to become more reasonable. I think if the market has to correct, you will see probably some of these expensive names also getting a little cheaper, hopefully. And all in all, that should be good for a more longer term horizon for an investor.
As of now, markets are hiding in defensive stocks. When do you think growth investing will make a comeback?
Well, right now these defensive names are also offering growth in a way. So, if you look at private sector banks, for instance, I think there is a fair degree of comfort on the fact that these are businesses that will continue to grow over sustainably long periods of time. Private sector banks are still only 30% of the entire market share of the banking sector. There's no reason why they can't be 50%. So I think some of these good businesses also have growth, and that is the combination that is probably attracting even more flow. But in some cases, like I mentioned, it will get overpriced. I think a lot of their growth over the next 3 or 4 years might get front-ended in terms of the stock price. And then what tends to happen is these stocks then, struggle to perform after that. But it does look like a lot of that is going to be front-ended, which is, in this trend, as I said, could perhaps get a little more extreme before it normalizes.
So what's on your radar? What I'm trying to understand is that what really could influence the way you would invest in the future?
Well, nothing that has changed dramatically, but we're constantly looking out for good businesses growing at a certain visible rate. So as I mentioned, private sector banks, for instance, still continue to be an interesting space to be exposed to. We're looking at automobile companies at some stage which will benefit from lower interest rates. Consumption as a theme, will have periods of challenge, but secularly it will work eventually. So clearly in the automobile space, that sort of there's some good companies there as well, and they broadly fit into this sort of top-down theme of consumption and lower interest rates. Within the engineering space, I think again you've got to be a little bottom up, but it does look like the industrial recovery or the cyclical recovery will probably still take some time, so that might be a late performer. There are areas like media, for instance. Telecom is beginning to look interesting now. Stocks have come off a lot, but it does look like there could be some pricing power coming back. Volumes continue to be reasonably robust. So it's you've got to literally look at everything from this price and volume matrix and see which sectors make sense or which stocks make sense. Where can you see a sustainable growth over a period of time, so that the valuation that you're paying at the moment gives you enough scope for performance. So it's very bottom up in that sense.
Tempting as it may sound, but are you still better off giving a skip to absolute infra and industrials, because whatever they have communicated up until now has not morphed into reality?
Sure. No, so infra has clearly been a very challenging phase to be, and it's very difficult to find investable ideas in infra right now. So most people are actually invested or sort of participating or trying to participate in the infra exposure through banks more than direct infra. Because direct infra companies continue to have severe challenges on their balance sheet. Valuations have compressed dramatically, so it's very difficult for them to raise capital. And these are businesses that require capital to keep expanding.